Welcome to the deep dive. You're here because you want the real story, fast. Today, we're cutting through the noise on Tata Consultancy Services, or TCS.
That's right. We've got an equity research report here from ICICI Securities dated April 11th, 2025. It's all about TCS, a huge player in IT.
And our mission, really, is to pull out the absolute must-know insights from this report. We want you to get a solid grasp of where TCS stands now and where it might be headed.
Without getting lost in the weeds, we'll cover their Q4 results for FY25, revenue forecasts, margins, deal wins, the whole picture.
Exactly. So let's jump right in. That last quarter, Q4 FY25, how did it look?
Well, the main takeaway is that it was weaker than expected, both on revenue and on profit margins.
Weak or how? Can you give the numbers?
Sure. Sequentially, their revenue actually went down by 1% in US dollars and 0.8% in constant currency. That was worse than estimates.
Okay, a dip. What about the full year, FY25?
For the full year, growth was 3.8% in USD, 4.2% in constant currency. So you can see that Q4 really slowed things down.
Right, a noticeable deceleration at the end. Why the slowdown? What's behind it?
It looks like a mix of things. There's the ongoing macro volatility, general economic uncertainty that led to some project deferrals.
Okay, the usual suspects. Anything specific to TCS?
Yes, and this is pretty significant. The planned ramp down of that big BS&L deal hit them, and it seems they couldn't quite backfill that lost revenue fast enough with new work.
BS&L deal, we knew that was tapering off, so that really impacted the numbers then.
It really did. The report specifically flags a sharp 6.4% quarter-on-quarter drop in USD revenue from the regional markets category.
Yeah.
Largely because of that BS&L gap.
Wow, 6.4%.
Yeah. And their India geography revenue also took a hit, down about 112 million US dollars compared to the previous quarter.
Okay, so some definite headwinds there. Was there any good news in Q4?
Actually, yes. One pretty bright spot was their total contract value, the TCV. They signed USD 12.2 billion worth of new deals.
12.2 billion. That sounds pretty good, right? Isn't their usual quarterly number lower?
Much lower. Usually it's around, say, 7 to 9 billion. So this was significantly higher. It suggests they are lining up future work.
Okay, so strong future bookings, even if the immediate quarter was soft.
That's the positive angle.
Yeah.
But need to add some context. That 12.2 billion, it's actually down 7.5% compared to Q4 the previous year.
Okay. So burr than usual for a quarter, but still down year on year.
Exactly. And the full year TCV, USD 39.4 billion, that was down 8% compared to FY24. So Q4 was strong, but the overall trend for the year was slightly down on deal wins.
Got it. A late surge, but maybe not enough to reverse the full year trend. Where did these Q4 deals come from? Any particular area?
The report breaks it down. North America was the biggest chunk, USD 6.8 billion.
Okay, still strong there.
Then BFSI banking, financial services, insurance, that was USD 4 billion. And the consumer business group brought in about USD 1.7 billion.
Right, so key markets and sectors still contributing. Okay, let's pivot a bit. What about profitability? The margins.
Right, the EBIT margin. It came in at 24.2% for Q4. That was actually down slightly, about 30 basis points from Q3.
30 basis points down. How did that compare to expectations?
Kind of mixed, actually. It matched one analyst's estimate, but was a bit below another. So not a huge miss, but, slightly softer.
So a little bit of pressure there. What squeezed the margins? What were the main factors?
Well, on the cost side, employee expenses were up. That took off about 90 basis points.
Wow, that's quite a bit.
Yeah. Then you had other expenses up slightly, adding 20 BPs pressure. Subcontracting costs also ticked up a bit to 4.8% of revenue. Another 20 BPs. Oh, and marketing costs were higher too, about 60 BPs impact.
Okay, so cost creeping up across the board, it seems. Anything pushing the other way? Any positive factors for the margin?
Yes, there were a few offsets. Interestingly, while the BS&L deal ramped down hurt revenue, it actually helped the margin slightly, probably lower associated costs.
Okay, makes sense.
They also had higher utilization, getting more billable work out of their current staff. And the weaker rupee helped too, boosting the value of their dollar earnings.
Right, so a real mix of puts and takes. What about the full year margin for FY25?
For the full year, EBIT margin was 24.3%. That was also down 30 basis points compared to FY24. So the Q4 pressure wasn't isolated.
Okay. And given this pressure and the macro uncertainty, how's TCS reacting? Any big strategic moves on costs?
One major one they announced is delaying wage hikes for the upcoming year, FY26.
Delaying hikes. That's a clear signal of caution, isn't it?
Absolutely. It's a direct lever to control those employee costs we just talked about. Shows they're being careful with spending right now.
Makes sense. What about headcount then? Are they freezing hiring?
Not exactly freezing. Their headcount actually went up slightly in Q4 by 626 people. It's a modest increase. The report notes it's similar to what Accenture reported.
Okay, so still adding some people. What about the plan for FY26?
They've actually indicated they plan to hire more fresh graduates in FY26 compared to FY25. The focus seems to be on bringing in new talent and really skilling them up, especially in AI.
Interesting. So delaying hikes for current staff, but still investing in fresh talent, particularly for AI, that's a nuanced approach. Okay, let's look ahead. What's the management saying about the future? Their outlook.
Well, there's definitely been a shift in tone. Last quarter, they sounded, pretty upbeat.
Mm-hmm.
Now, much more cautious.
Why the change?
They're citing that increased macro uncertainty again, and specifically mentioned seeing more project deferrals happening in March. So they're acknowledging the environment's gotten tougher.
More cautious tone? But what are they actually forecasting for this year, FY26?
Despite the caution, they're still saying they expect FY26 revenue growth from their international business to be better than FY25's growth.
So still expecting an acceleration, even with the headwinds.
That seems to be the message. Although they do acknowledge the uncertainty around discretionary spending specifically.
Okay. How do the analysts at ICICI Securities see it? Are they buying that optimistic view for FY26?
They seem a bit less convinced, actually. The report suggests the analysts expect low discretionary demand to continue weighing on growth in FY26. So there's a bit of a gap between management's outlook and the analyst expectation here.
Right, that's a key point of divergence. But the report does still sound positive on TCS overall, doesn't it? Mentioned their resilience.
Yes, absolutely. Despite the short-term caution, the analysts believe TCS is actually better positioned than many rivals to handle this environment.
Why is that? What makes them resilient?
Well, several things. Their established leadership in the industry, for one. Their consistently strong return on equity, which is a key financial health metric. And just their track record of solid execution. They see these as strengths that will help TCS weather the storm.
Makes sense. Leadership, financial strength, execution. Okay, let's dig into where they see future demand. What are the hot areas?
They highlighted quite a few. Things like migrating clients to SAP S/4 HANA are still big. Obviously, GenAI implementation is growing fast.
Gen AI, no surprise
All
there.
right. Also, automating software testing, modernizing old legacy systems and data platforms, building custom AI and ML models for clients. It's a mix of core modernization and newer tech.
So plenty of work still needed in those foundational areas, plus the new AI wave. Anything else?
Yeah, improving customer experience using digital tools, general digital transformation projects, and just broad AI adoption across businesses. And interestingly, management specifically called out agentic AI as the next big thing.
Agentic AI, what's that? Like AI that acts more independently.
Sort of, yeah. Moving beyond just chatbots to AI systems that can take more initiative, perform tasks more autonomously, that's what they see as the next frontier.
Interesting. So how is TCS approaching this whole AI opportunity strategically?
Their approach seems to have three parts. First, focusing on industry-specific AI solutions, tailoring it to different sectors. Second, scaling up through partnerships, like with the big cloud providers. And third, a big emphasis on responsible AI, the ethical side.
Okay. Industry focus, partnerships, responsibility. And is AI helping or hurting their own business model right now?
It's a bit of both.
Yeah.
It seems net positive. They mentioned sharing some AI-driven productivity gains with clients, which might affect pricing a bit,
Uh-huh.
but they're also capturing a larger slice of the client's overall IT budget because of these new AI capabilities.
Mm.
So it's opening up more revenue opportunities overall, even if it makes some old tasks more efficient.
Got it. Adapting to the change. Now, how did the different sectors perform in Q4? Any standouts or weak spots?
Looking at quarter-on-quarter USD growth, healthcare was down 1%, but apparently improving. Manufacturing was also down 1%, mostly due to weakness in auto and aerospace tied to the EV slowdown and inventory issues, it seems.
Okay, specific industry pressures there. What about BFSI? That's usually a bellwether.
BFSI actually grew 1.3% sequentially, which sounds positive, though the report mentions some softness in insurance specifically. Retail was down 1%. Technology sector was okay. Communications saw better demand.
And
Energy and utilities grew 0.8%. So, yeah, quite a mixed bag across the verticals.
definitely. And geographically, we know regional markets were hit hard by BSNL.
Right, down 6.4% QOQ in USD. But Europe was actually up 1%, driven by those large deals they won earlier.
Okay, Europe holding up. Americas.
Americas were pretty flat, down just 0.2%, and they mentioned good growth in the Middle East and Africa. So Europe and MEA doing okay, America's flat, regional markets down significantly.
Got the picture. Any other interesting metrics or points from the report?
Yeah, a couple. That book-to-bill ratio improved, went from 1.4x in Q3 to 1.6x in Q4.
Okay, so stronger bookings relative to billings. That supports the TCV story.
Exactly. On the other hand, attrition actually ticked up slightly by 30 basis points to 13.3%.
Yeah.
Something to watch.
Yeah, definitely. What about their own software platforms like Ignio?
Good progress there. Ignio, their AI automation platform, got 30 new deals and had 11 go-lives. They even mentioned its code accelerator boosts their own coding efficiency by 150%. And CS, the finance platform, had 4 new wins and 4 go-lives. So those platforms seem to be doing well.
Good traction. And client numbers. Any changes in the size of their clients?
They saw growth in the number of clients in the $1 million, $5 million, and $20 million plus bands. The top tier, $100 million plus, stayed flat, but they actually lost clients in the $10 million and $50 million buckets.
Huh. So growth at the lower and mid-upper end, but shrinking a bit in the middle, lower, and upper middle. Interesting.
Yeah, maybe some shifting dynamics in the client portfolio. Oh, and they announced a final dividend of 30 rupees per share for Q4.
Right, dividend news. Okay, let's pull it all together. What's the final verdict from ICICI Securities, the recommendation?
They're sticking with an ADD rating, which generally means they expect a return between 5% and 15% over the next year or so.
An ADD rating and the price target.
They set it at INR 3,680, looking out to March 2026. That's actually a slight reduction from their previous target of 3,880.
Okay, lowered the target but kept the ADD rating. What's the logic? Why ADD?
Valuation, mainly. They think the stock looks attractive right now. It's trading near its 5-year average minus 2 standard deviations, which suggests it could be cheap compared to its history.
Undervalued historically.
Potentially, yeah. And its price-to-earnings ratio, based on FY25 earnings, is around 24.2x. That's below its 5-year average PE of 27.7x.
Okay, and how does that valuation compare to the rest of the IT sector, like the Nifty YIT index?
Right now, TCS is trading pretty much at par with the Nifty YIT, but historically it's usually traded at a premium, about 10.8% on average over the last 5 years. So trading at par makes it look relatively attractive within the sector too.
So the valuation argument seems pretty strong from their perspective. What about risks? Did they flag any major concerns?
Yes, 2 main ones. First, the risk that discretionary spending cuts by clients could be even sharper than expected. That would obviously hit growth harder.
Makes sense.
And second, the risk that backfilling that BS&L revenue takes longer than planned, which would continue to drag on their regional market performance.
Both seem very relevant right now. Okay, lastly, just to give listeners a flavor, did the report include financial projections for the next few years?
It did. They provided estimates for net revenue, EBITDA, net profit, and EPS for FY26, 27, and 28. The general trend is positive growth expected across the board over those 3 years, but the pace varies. It reflects that gradual recovery and growth story.
Right, so anticipating improvement over the medium term. All right, let's wrap this up. If you had to boil down the key takeaways from this deep dive for our listeners, what would they be?
I'd say TCS had a tough Q4 FY25 hit by macro factors in that BS&L deal specifically. But their deal wins, that strong TCV in Q4, offers some hope for the future. Analysts are still a bit cautious short-term, worried about spending levels. Strategically, though, TCS is clearly focused on AI and navigating this tricky economic climate.
A good summary. And here's something to think about. We've got these mixed signals, right? Weaker recent results, but really strong deal wins, and this big push into AI, even talking about agentic AI. So the provocative thought is, what are the real leading indicators you should be watching over the next few quarters to figure out which way TCS is actually heading? Is it the spending environment, the deal conversion rate, tangible results from AI?
That's the key question. It forces you to think about what really drives this business beyond just the quarterly earnings beat or miss. You need to watch client sentiment, tech adoption trends, how effectively they execute on those big deals.
Exactly. It's about understanding the underlying dynamics. This look at TCS really gives us a window into the broader IT services sector and the economic trends hitting tech spending. We hope this deep dive was valuable.
We'll keep bringing you these analyses. Thanks for joining us.